All right, now let's get into some specific estate tax strategies for non-U.S. residents. And we already know what non-U.S. resident is. The code defines it as a taxpayer who resides in the U.S. with an intention to go back to their home country. That's a non-U.S. resident. So a non-U.S. resident is someone that just visiting in the U.S., they don't have an intention to remain here indefinitely, then they're a non-U.S. resident for estate and gift tax purposes. So the code carves out several exceptions for non-U.S. residents that no action needs to be taken. This is already in the code. We just need to be aware that they exist so we can counsel our clients accordingly. So what is not considered property for non-U.S. residents for federal estate tax purposes? And again, I cite the code sections there. So if you have a non-U.S. resident and they have a U.S. life insurance policy, that's number one, on their life, that is exempt for estate tax purposes for a non-resident. So again, if they have a U.S. life insurance policy, let's say they have a $10 million life insurance policy on their life, they pass away, that is exempt for estate tax purposes for a non-U.S. resident. The same is not true for U.S. citizens. If you're a U.S. citizen, you have a life insurance policy, the value of that life insurance policy upon death is part of your taxable estate. For non-U.S. residents, it's an exception, it's in the code. Number two, bank deposits. Personal bank deposits under their name, personal checking, savings, CDs, not used in the business in a U.S. bank within the United States, those are also exempt for non-residents for estate tax purposes. So they can have, again, $10 million in a checking account and BBVA Compass. That would be exempt for estate taxes because they're non-U.S. residents. A less common example there, works of art for loan, on loan for exhibition, like in a museum, that's exempt for non-residents. Number four, this one would apply to my client from Mexico that the family just hired me a couple of weeks ago. Debt obligations and portfolio interest exemptions under Internal Revenue Code 871. So basically, the summary of that is if they have certain investment portfolios that would qualify under this portfolio interest exemption, then that would be non-taxable for a non-U.S. resident. Now, this is a very technical section of the code. So normally what I do is I ask the brokerage or the bank, hey, does the investment fall under 871 of the code, under the portfolio interest exemption or debt obligation? And I would basically rely on the financial institution to certify if it qualifies under this exemption. And finally, property outside the U.S. is not part of a taxable estate for a non-resident because it's outside the United States and they're non-residents. The same is not the case for U.S. citizen. U.S. citizen, worldwide taxation, non-U.S. resident, only their U.S. situs assets. All right. Here are some additional estate tax strategies that are in the code, but these require action. So the prior chart here, again, no action needs to be taken. These are already carved out in the code. These additional ones, action needs to be taken. So a qualified domestic trust is basically available for the surviving non-resident spouse. It's basically like a marital deduction, and it just postpones the payment of the estate tax until the surviving spouse dies. So again, it's similar to doing a marital deduction plan for U.S. citizens. It's called a QDOT. I don't use these very often because there's a lot of technical requirements to qualify for these domestic trusts for non-U.S. residents. There's other strategies that we can use for our clients, but again, this is one that we can do post-mortem that it can be used for the surviving spouse. And finally, charitable planning. Non-U.S. residents enjoy charitable deductions just like U.S. citizens under the code, so we can also do charitable planning. Some additional strategies that we have here is offshore entities. So non-U.S. based entities to own U.S. situs assets to avoid federal estate taxes, because your non-resident client will not own it in their name. So again, let's say you have a client that has some real estate in Houston, it's a vacation property, or maybe it's a commercial property that they're leasing. One strategy is we can use on non-U.S. based entity, maybe British Virgin Islands Corporation, or some other jurisdiction. so that they don't own that real estate in their name. So using offshore entities is another option as an estate tax strategy for non-U.S. residents. Okay. Now note, if you're going to use offshore entities, there's additional disclosures that the IRS will require. And we also have to do a tax analysis in the foreign jurisdiction to see what taxation is going to be due in the home country. So, for example, if we're using British Virgin Islands as an offshore entity, again, what are the tax laws in the BVI? Well, basically, they don't have to be taxes there if there's no revenue being generated there. But again, we have to do analysis on a country by country basis. Since we're so close to Mexico, the majority of my non-resident clients are from Mexico, so we have to use offshore jurisdictions with caution, because in Mexico there's a quote-unquote blacklist that the Mexican government considers illegal because they're used as tax avoidance jurisdictions. So again, depending on what country your client is from, I know that for Mexico we have to be very careful, because there is a blacklist of jurisdictions that are basically tax avoidance countries, and they come with criminal penalties. Okay, so you have to be very careful what offshore jurisdiction you're going to use for your clients, because that may be illegal in their home country, and it can get them into a lot of trouble. So again, it depends where your client is from. You need to check with their foreign counsel to see, hey, if I'm going to use, for example, Nevis or British Virgin Islands or the Bahamas, is that okay in their home country, or is that going to get them into trouble? So that's one huge red flag caveat that we have to use with our international clients, is you want to make sure that you communicate with their counsel in their home country to make sure that the strategy that you use makes sense in their home country as well. Also, another issue of using offshore entities is beware of the reliability of the judicial system in the foreign jurisdiction. Okay, so again, using my Mexican clients as an example, is I pretty much blanket discourage my clients from using Mexican business entities to own their U.S. assets. So the reason I discourage my Mexican clients from using their Mexican corporations from owning their assets in the United States is the reliability of the judicial system in Mexico. So my clients have told me horror stories over the years of the Mexican IRS, which is the SAT, the SAT, that's the Mexican equivalent of the IRS, how they just unilaterally freeze their assets, freeze their bank accounts, no due process, unilaterally, and then they're fighting the Mexican IRS in court for years. So over there, again, you don't have to do a process like we do with the IRS. Before the IRS seizes your asset, they're going to send you letters. There's going to be opportunity to get on a payment plan for taxes. There's all kinds of things the IRS will do before they seize your client's assets. In Mexico, that's not the case. They will freeze your assets, take your bank account, and then you have to fight the government later to get it back. So again, taking my Mexican clients as an example, that's why I never recommend that their Mexican corporations own their US-based assets, because if they get into trouble with Mexico and that Mexican corporation gets frozen by the government, they're putting their US assets at risk. So again, you have to be aware of the reliability of the judicial system in their home country if they're going to use those business entities to own US assets.